Hello, my name is Kritika Ratan. Today, I am going to present corporate accounting concepts for income tax. These accounting concepts will be reviewed through Commonwealth Group's Annual Report 2018-19. Introduction. Corporate accounting is a subdivision of accounting which deals with the accounting for companies' preparations for their final account and cash flow statements and interpretations of companies' financial result. Therefore, corporate accounts for income tax is to be recognized tax liability for projected income tax payable and calculate income tax expense for the current period. This study will review the corporate accounting concepts such as accounting profit, temporary difference, taxable temporary difference, deferred tax assets, and liabilities for income tax through using Commonwealth Group's Annual Report 2018-19. Furthermore, Commonwealth Group's financial statements and balance sheet is examined to figure out the firm's income tax expense, income tax payable, and income tax expenses. This study will end with some interesting, surprising, and confusing findings of this report. Terms related to accounting for income tax. Accounting profit. Accounting profit is a measure of profit resulting of accounting rules and applying a journal accepted accounting principles. Accounting profit is calculated by accrual method. Accounting profit comes when we deduct accounting expense from accounting income. Now, the taxable profit. Taxable profit is using the cash method of tax accounting based on tax rules. As a result, taxable income is obtained from cash revenues and expenses in tax reporting period. Taxable profit comes when we deductible expense deduct from the taxable revenues. When the accounting base and tax base of an asset and liability different, it is called a temporary difference. Temporary difference further divided into two categories: taxable temporary difference or deductible temporary difference. When carrying amount minus tax base, result comes to taxable or deductible temporary difference. A deferred tax liability should be recognized for all taxable temporary difference, whereas a deferred tax asset is recognized for all deductible temporary differences. Deferred tax asset. A deferred tax asset is an item which is placed in the balance sheet that result from overpayment or advance payment of taxes. The carrying amount of an asset is less than the tax base. Income tax expense has been higher in the earlier periods. When deductible tax difference is multiplied by tax rate, it results is deferred tax asset. Now, deferred tax liability. Deferred tax liability is a tax which is assessed or is due for a particular temporary tax period but still unpaid. The deferral arises when there is a difference in timing or a tax accrued for payable. When temporary tax difference is multiplied by tax rate, it results is deferred tax liabilities. Now, what is the recognition criteria of deferred tax assets and liabilities? Deferred tax asset. Deferred tax assets relating to temporary difference and tax losses. There are number of assumptions made in order to recognize deferred tax assets. The entity will remain in business and it is referred to going concern. In the future years, taxable income will be derived and pay more tax. Recognition of deferred tax assets same as applied to the other assets, and it is reliance on probability tests. Now, what's the recognition criteria of deferred tax liability? Deferred tax liability must be recognized in full, pay more tax in future, and shall be recognized for all taxable temporary difference. Tax expense. According to AASB 112, tax expense is the collective amount included in the determination of profit or loss for period in respect of current assets and deferred tax. Firm latest tax expense. According to Commonwealth Bank Annual Report 2019, total tax expenses cited in the financial statements are $3,437 million, which were decreased by 12% from $3,920 million financial year 2018. This was primarily because of non-reoccurrence of the $700 million Austrac civil penalty incurred in the last year 2018, which was non-deductible for tax purposes. Income tax expenses versus company's tax rate times accounting income. Accordingly to the Commonwealth Group's Annual Report 2019, the company's tax rate times to the accounting income and income tax expenses figures are differ. The income tax expense is $3,447 million and tax on accounting profit is $3,529 million. Deferred tax assets liabilities reported in balance sheet. According to Commonwealth Group Annual Report 2019, the total deferred tax assets are $1,675 million in the balance sheet, which means Commonwealth Group has paid the taxes in advance and it is supposed to return back these taxes. A deferred tax asset is recorded on the balance sheet when a business has overpaid taxes and taxes are paid in advance. A deferred tax liability is an account on a company's balance sheet that is an effect of temporary difference between the company's accounting and tax carrying values. The estimate and intact income tax rate and predictable tax payables for the current year. Current tax assets or income tax payable. According to the Commonwealth Group Annual Report 2019, current tax assets are $624 million. The company does not have income tax payable as it has paid all the income tax expenses. Income tax payable and income tax expense. Why this is a different. Income tax expense is connected to the accounting profit, whereas income tax payable is connected to the tax profit, and both are different. Income tax expense shown in balance sheet and income tax paid shown in cash flow statement. The annual report 2019 shows the income tax expense placed in the income statement are $3,391 million and income tax paid cited in the cash flow statement are $4,878 million, which are not same. The amount of income tax expense that appears in the income statement rarely equals the amount of income tax actually paid during the year. There is a formula to calculate the income tax paid. When income tax payable is a decrease, then it is added in the income tax expense, or when income tax payable is an increase, then it is deducted from the income tax expense. Both gives the result are same, income tax paid. Temporary difference and permanent difference. Temporary difference when there is a difference between the tax base and the carrying amount of assets and liabilities on the balance sheet, it is called a temporary difference. Permanent difference when there is a difference between the tax and financial reporting of revenue or expense items which will not be reversed in the future, it is called a permanent difference. Therefore, transactions are never recognized as a part of taxable profit. There are some examples of permanent difference are fines and penalties, meals and entertainment, politicals and contributors, officers, life insurance, and tax exempted rate. Commonwealth Group tax expense shows the $700 million Austrac civil penalty incurred in 2018, which is an example of the permanent difference. Understanding about the treatment of tax. The most interesting part about the tax treatment in the financial statement of Commonwealth Group is that the tax expense is not adjusted for the deferred tax component and other adjustment for prior years. Moreover, the most confusing and surprising part of the treatment of tax is the creation of deferred tax liability and the calculation of the same. On the other hand, it is difficult to consider the difference in the accounting standard and taxation rules. A new insight relates to tax treatment in how companies tend to calculate tax as per the accounting standard and tax rules, and also manage to reconcile the difference between the both through the creation of deferred tax assets and liabilities as may be its prerequisite. After reviewing all the corporate accounting concepts, it is found that how Commonwealth Group and other companies calculate tax using accounting principles and tax rules. This study concludes some interesting facts related to income tax expenses adjustments. Overall, all of concepts and facts can resulted in compound calculations to reach at the appropriate income tax information recognized and report in the financial statement. Thank you.